Good evening. We shall start our session now. Ladies and gentlemen, a very good evening. Welcome to another FSM1 event where we help investors to invest globally and profitably. First of all, I'd like to thank all the participants who have registered and joined tonight's webinar. My name is Bhushan, the client investment specialist from FSM1, and I will be your MC this evening. During this webinar, feel free to drop your question at the Q&A session, and our speaker will address your questions at the end of the session. The topic for today evening is Malaysia Equities, defensive growth and unique opportunities in a challenging environment, presented by Mr. Lee Pak Seng, the portfolio manager at AIIMAN Asset Management Sdn Bhd. With that, allow me to introduce our speaker. Mr. Lee joined AIIMAN Asset Management in March 2009 as a portfolio manager. He has over 7 years of experience in the investment industry. Prior to AIIMAN, he was a portfolio manager at Manulife Asset Management Services Berhad, managing Malaysia-focused portfolios as well as research coverage in the manufacturing, technology, telecommunications, and utilities sector. Mr. Lee holds a Bachelor of Arts from the University of Manchester, United Kingdom. Let me also briefly give an introduction to AIIMAN Asset Management Sdn Bhd and AHAM Asset Management Berhad. AIIMAN Asset Management Sdn Bhd is a Sharia-compliant investment management company, and it is a wholly owned subsidiary of AHAM Asset Management Berhad, which was formerly known as Affin Hwang Asset Management Berhad, an institutionally owned, independently managed asset and wealth management firm. Over the years, AIIMAN's suite of Sharia-compliant offerings has been recognized for its outperformance and has received numerous industry accolades for its commitment to driving excellence and innovation in the industry. With that brief introduction, let's welcome Mr. Lee Pak Seng. Over to you, Mr. Lee. The floor is all yours.
Okay, thank you. Let me share my slides. Okay, first I'd like to thank you all for taking the time to listen to this webinar. I'll give a brief outlook on Malaysia and current global investment environment and why Malaysia is actually quite a relatively defensive market, even though the headline numbers like our benchmark performance might not show it. Okay, so to begin, you see the slide. I think past more than a year plus, we've seen a series of headlines that has impacted investor sentiment over the past year and a half. So I think most recently we've seen some bank failures in the US and also Europe, namely First Republic Bank, Silicon Valley Bank, Credit Suisse, and also for the past 1 year, more than a year plus, we've seen consistent interest rate hikes, not only in the US, but globally as well. European Central Bank, Australia, even Bank Negara Malaysia. And on top of that, you have the China-US trade war, and then the Ukraine-Russia war. And now it's concerns of a recession, given that the elevated interest rates are starting to impact economic growth. And the recent bank failures are a good early indication that the higher rates are starting to affect the corporate sector. After coming out from after the easy monetary and fiscal stimulus provided by the government and central banks, the sharp tightening has likely slow down the global economy, and also at the same time crimp economic growth. Okay. So this slide shows the year-to-date performance of Malaysia market versus Asia and US and the world. So unfortunately, Malaysia is the bottom two lines with the KLCI, the white line at the bottom, and the Sharia EMAS index outperforming the KLCI year to date. And then you can see the global, regional, and US markets are outperforming in a quite significant amount. And if you put in a relative perspective, I think Malaysia market represented by the KLCI, is actually one of the worst performing indices in the world. Actually, not the worst, but one of the worst. Next few slides, I'll show you what are the reasons that is causing all this weakness. Okay, so you break down by sectors, you can see that it is broad-based. The weakness is across most sectors. But if you look for the KLCI, it's mainly driven by these three sectors highlighted in the black bars. So if you look at the far right, which is the year-to-date performance, it's the finance index, plantation, and industrial. So plantation, of course, given the strong growth seen last year due to the pandemic, and also sharp rise in CPO prices, some of the plantation companies have seen sharp increases in their profits, and it's back to normality for this year onwards. So of course, as a result, the share price has actually come down quite significantly. And the other one is the finance index, mainly the banks, which has dragged down the KLCI, and also industrial. Due to the high interest rates, it has actually impacted a lot of the growth sector stocks. So most of it is under the industrial and also technology sectors. Okay. Who has been selling? If you see the red square on the far right, it's mainly the foreigners. So foreign funds have actually been exiting Malaysia equity market, while the net buyers are actually the local institutions. So your domestic funds have been actually buying from the foreigners as they aggressively sell the domestic market. So there are a few reasons why foreigners are leaving. One of it is because of the strong US dollar. So the money is flowing back. Another one is limited growth prospects versus the region. So Malaysia corporates, especially your large cap, showing slowing earnings growth and also low earnings growth numbers relative to other parts of the region, and also due to the weakening ringgit. And on top of that, the strong US economic performance is actually attracting more capital inflows back into the country. And with the rising interest rates from the Federal Reserve, it's actually attracting a lot of money flows also to the fixed income market and also the cash market. Okay, so which is why relatively the attractiveness is much better than domestic market. And if you see Malaysia is actually versus in the region, Malaysia only constitutes about 2% of the MSCI Asia index. So relative wise, Malaysia is actually a very small market. But that doesn't mean that Malaysia has nothing attractive. There's still a lot of value in the market. And especially with the reopening of China, we're actually one of the biggest beneficiaries from this trend. Okay. So you see on economic growth prospects, our economy remains quite resilient. On the 2023, expected GDP growth is 4%. So it's relatively high in the region as well. And next year is 4.5 and 4.3. So overall, it's quite stable and stable economic growth. Given that most of our economy is domestically driven, on top of that, we are blessed to be net commodity exporter, mainly oil and gas, and also your plantation sector. So those will help bolster our economic growth. And on top of that, with the windfall from all these commodities going to government fiscal balance, it does allow the government to continue to subsidize a lot of the goods in Malaysia. So hence our inflation numbers are not as drastic versus the rest of the world. Hence, Bank Negara does not really need to tighten monetary policy as much, and hence won't impact economic growth as much as well. And the next slide is earnings growth for the KLCI. As you can see, for 2023 and 2024, it's quite a strong rebound from your 2020, 2021 and 2022 earnings growth numbers. Okay, so the strong rebound is of course due to the absence of Cukai Makmur and also full reopening of the economy. And beyond that, I think other windfall is since 80% of our economy is from the export sector. With the China reopening and expected pickup in demand, our export sector will likely benefit as well. And in terms of corporate earnings expectations, if you see the blue bar on the far right, if you follow the trend of the blue bar over the years, over the quarters, you can see that it's starting to expand, meaning corporate earnings are starting to come in line, which means that market has well priced in a lot of the corporate expectations. So hopefully moving forward, expectations of corporate earnings should hopefully come more in line and also a bit more above expectations, which should drive our equity markets moving forward. In terms of valuations, the most basic one will be looking at price earnings ratio. So this is the KLCI PE. On the far right, you can see that it's at 13 times. Historical average over 10 years is 16.5. So valuation-wise, we're actually at very, very cheap levels. But of course, some can justify that it's due to slower earnings growth. But the PE also incorporates consensus estimates of future earnings. So likely is that valuations are attractive. But just a caveat, valuation is not a good tool in terms of market timing, but it does give an indication of where the market is relative to its historical valuations. So at the moment, it is very, very cheap levels. So just to add, so should there be any recovery in the corporate sector, actually the rebound for the domestic market could be very strong as it reverts back to the median mean level, which is 16.5 times. So summarize, what is the main headwinds? Of course, recessionary fears, corporate banking stress, and geopolitical challenges. So as you can see, all of this is actually macro issues beyond our country. Domestically, tailwinds, of course, is a very supportive government and a central bank. Reopening of economies, which Malaysia has trade agreements with, such as China, and also depressed valuations for domestic market. So all these are actually a push and pull factor for our domestic market. And so far, what we've seen is that with the selling of foreigners, it's actually pressuring our domestic market down. But nonetheless, domestic funds are actually quite optimistic about our market prospects moving forward, which is shown by the strong net buying of domestic institutions. Okay, so what we are looking at in terms of investment themes, for the moment, we are taking a more defensive stance, focusing on dividend yielders and companies and sectors that provide stable earnings and those that can pass through in a rising cost environment. So such sectors will include such as consumer staples, your telco sector, and your REITs. This is rightly so because given the current market environment is quite volatile and the risk of a recession is actually very high. But of course, we are also keeping some elevated cash levels as well, ready to deploy the cash when market starts to decline. And when we see that turning could be quite soon. So at the moment, we are quite defensive to protect the capital of the portfolios. Moving forward, the other theme, of course, is the reopening. This has been a theme for the past 2 years. But actually for this, since the end of last year, it's changed to the reopening of, besides Malaysia, it's China now. So China is actually quite a major export customer of Malaysia. So this will benefit your manufacturing sector, your commodity sector, and also some of your consumer industrial sectors as well. So these are some of the sectors we are looking at under this theme. And of course, the next is tech and manufacturing. This, I think, at the moment, is not a time for us to accumulate. We're actually keeping in view of the tech sector. So valuation is still quite high, given that the tech sector has actually rebounded quite substantially since year to date. But in any events of any heavy sell down, we look to accumulate a lot of these companies at much cheaper valuations, because in the whole of the entire market, it's the tech and manufacturing sector that provides the strongest growth. So let's say for generally Malaysia, earnings growth for the corporates are about 5 to 10%. but your technology and manufacturing can actually deliver earnings growth about 20 to 40% year on year. So it is a great sector to actually position in to obtain alpha. So certain themes, what we're seeing is the 5G, electric vehicles, solar panels, a lot more, IoT, etc. So we do have a lot of companies in Malaysia that actually are part of the supply chain that supply to these themes. These are technology themes, and their end customers tend to be in China, the US, and also Europe. And of course, the continued China-US trade war does provide Malaysia some benefits, as a lot of the manufacturing capacity is actually redirected to Malaysia. So what we've seen is that a lot of companies in Malaysia are seeing rising orders from existing and new customers, which are largely MNCs. And many of the reasons is because of trade diversion and also diversification. Other than the trade war is diversification after the experience with COVID, where they want to diversify their sources of manufacturing. I think a lot of corporates are actually badly affected due to the lockdown measures done by China, and it made them realize that having most of your manufacturing capacity in one country is a major risk. So all three themes, these are the major themes we're looking at for this year, and hopefully it will deliver in terms of fund performance and also alpha. Okay, so to summarize, our view for global is that we prefer Asian markets due to attractive valuations and stronger growth, supported by China's reopening. The probability of a US slowdown and also a European one is actually quite elevated. And the likelihood, the current view is that it's not whether a recession will happen, but a matter of how deep the recession is. So I think last year, second half of last year, market expectation was for a shallow recession. But looking at how events has unfolded lately, it looks like there's a risk of a deep and prolonged recession. And if inflation remains quite elevated, there's a greater risk of a stagflationary environment. Hence, we prefer the Asian economy, where China is actually not in the same situation as the US or Europe. It's actually experiencing low inflation and also a very supportive government and central bank. So hence, for Malaysia, after the persistent selling of foreign funds, most of the sectors are actually negative this year, but it does imply that they are trading at very attractive valuations. And on top of that, domestic earnings and outlook remains quite intact. Even though, yes, there is guidance of slower earnings growth, it's more or less priced in already. Hence, a lot of the market risk is actually coming from your US and Europe, such as your politics, policy, and also recession. So hence, as mentioned earlier, we'll continue to maintain a defensive position with cash to, of course, capture opportunities and also to protect the capital of the fund. But of course, we are keeping a close view in terms of the market direction, also macroeconomic conditions, such that it will allow us to time our deployment of capital in order to capture opportunities. Okay, so that's outlook. Open to take any questions. Okay, if not, I'll move on to the fund. Okay, so I manage the AIIMAN Growth Fund. Okay, so it's a Sharia fund. So I think a lot of questions are wondering why invest in Sharia, what is Sharia investing? So it is basically an investment principle which complies with Islamic beliefs. Consideration includes investments that are free from interest, speculation, and sin activities. So your halal activities, no alcohol, no gaming, no tobacco. And of course, financial limits such as your debt to cash ratio and also relative to total assets. What allows Sharia investing to differentiate from your conventional investing is that it is defensive by nature due to the restriction of, especially for the financial limits, where it does not allow one to invest in companies that are high high gearing. Okay, and also diversification, since the components of let's say the restrictions in certain sectors allows Sharia to actually have a lower correlation between conventional. So it is a consideration for diversification under one's investment decision. And also it's a form of ESG, ethical form of investment, where it focuses more on socially beneficial businesses. So, which is why it excludes sinful activities. So what's the objective of the AIIMAN Growth Fund? So it's basically to provide capital appreciation in the mid to long term in Sharia compliant investments. And the advantage of this fund is that it allows the investor level to be reduced to 70% and 30% cash. Hence, this allows the fund to, let's say in a volatile or weak market condition, the fund will actually raise cash to 30% max. And at the same time, when the market starts to turn, we can deploy the cash and capture opportunities. So I think the objective, of course, is to keep investor level quite high, maybe 80 to 90% on average in a year. But the key objective of this option is to allow us to capture opportunities in market weakness. So the focus of the fund, of course, the universe is in growth stocks in the domestic market. Okay. So in terms of performance, year to date, it's outperforming the FPM AIIMAN Sharia as of end Feb. Okay, so 2.4% versus the Sharia negative 1.3. I think over the years, the fund has shown that it has consistently outperformed the benchmark, save for 2022, given that the sharp hike in interest rates has actually impacted a lot of the holdings of the fund, which was mainly in growth stocks, which is why 2022 it underperformed the benchmark. But other than that, the other years it has consistently outperformed the benchmark, and we hope to do so in the years ahead. So on an annualized basis over the past 1, 3, 5, 10 years, it has outperformed the benchmark quite considerably. And the objective, of course, is consistent return over the medium to long term. So 1 year, it might show some negative numbers, but over the 3 to 5 years, we target to continue to add to the strong annualized performance seen over the 3 to 5 years. In terms of holdings, the fund is holding on implementing a barbell approach, where one side of the fund is actually heavily in defensive sectors. So your yield, your stable earnings sectors, and the other heavy holdings will be in your growth. But that, of course, for the time being is not as heavy, given that we've moved to cash in anticipation that in a market recovery scenario, it's actually the growth sectors that will rebound the fastest. So as you can see, a lot of the holdings in the top 10 are mostly in your telco, REITs, or your utility sector. So it's more defensive. So I think that's all from me. Open to any questions.
All right. Thank you, Mr. Lee, for the insightful presentation. Now we shall proceed to the Q&A session. And let's kickstart the first question by Hari. Hari asks that, why do you see the GDP forecast for China is on a descending mode?
On a descending mode?
Yes. Why do you see the GDP forecast for China is on a descending mode?
I don't think it's on descending mode. I think the growth is, yes, quite stable. I think market is expecting them to see a stronger growth versus I think the 5% growth guided by the Chinese government, because market is expecting that the Chinese government to implement quite aggressive stimulus policies. But I think they're quite quite comfortable with 5%. I think just to clarify, I think the Chinese government is focusing on long-term sustainable growth, not the aggressive growth you see in the years before, where you are seeing 7 to 10% annual GDP growth, which I think has caused some problems with the Chinese market. A good example is the property sector, which has suffered quite a negative shock over the past few years, given the strong overheating and also overstimulus from the Chinese government. So now they're trying to control this kind of events happening from occurring to their other sectors. Hence, they are focusing more of a sustainable trajectory. So I think that's the reason why China's growth might not be what you expect from the years before. So what they are trying to do is, instead of 1 year 5, 1 year 10, 1 year -10, they're trying to target a 4 to 5 to 6% growth on a year-on-year basis consistently.
Okay, thank you for the explanation, Mr. Lee. Our next question is by Steve. He asks that our main headwind, which is here for so many years, is the country's political instability, and foreign investors are shying away from here. So kindly share your thoughts on this.
I think that's a good concern, but actually politics has become less and less of a concern to foreigners. So if you see last year, we've seen maybe changes in 2 prime ministers, but we had net inflows of foreign flows. So it's actually not really that a major push factor for our domestic market. It's actually our earnings growth that drives foreign interest. So if we do show that we are able to sustainably deliver earnings growth, I think foreigners will likely come back in. Also, if you see, as mentioned earlier, this year is because of the strong US dollar as well, which have seen a lot of funds actually pulling out from Malaysia. Also, I forgot to add, it also coincided with the reopening of China. So a lot of funds that flowed into Malaysia have actually flowed out back to the US and also back to North Asia and China as well.
Okay, thank you. Next question is from our Facebook. Just now you mentioned it is better to overweight defensive sector. What is the fund strategy moving onwards in terms of defensive, growth, cash weightage, and what is the near-term catalyst you're expecting to drive the market?
So defensive, of course, as mentioned, yes, the fund will remain defensive for the time being. Cash is about 15%. I hope that the market does continue to go up, but for a moment, it seems like a lot of uncertainty, given that the macro data is actually quite challenging. So expectation is that the domestic market will likely languish at current levels, or we might even see weakness if macro data does not improve. So the fears is that there is a recession. Then of course Malaysia will not be spared. But relatively wise, unlikely to see a sharp decline as much as what you see in other markets such as your US or Europe. So the time being is that the fund will continue to maintain some cash levels, and hopefully will deploy when conditions are better. But just a caveat is that what we've seen is that, let's say last month, with the failure of Silicon Valley Bank or even Credit Suisse, the actions of the central bank and the government has been very fast. And also, even if you look at 2020 when COVID hit, the decline in the market, the subsequent rebound happened very fast. So yes, I mean, we are expecting market to decline, but the rebound will also be very fast. So it's a matter of capturing this rebound in the market.
Okay, on that note, when you mentioned about banks, right? There are 2 questions from anonymous attendees. I'll just ask that together. The first question is that what is the outlook on banks? That's a general question. And another question is on the banks in Hong Kong and China. So outlook on banks in general and banks in Hong Kong and China.
Okay. I can't answer the question on banks and outlook banks for Hong Kong, China, because it's not my specialty. But for domestic banks, it has benefited a lot last year due to the rising interest rate environment. And now the expectation is that interest rate has likely peaked. So upside and catalyst for the banking sector is quite limited. And if the economy or global economy does see a slowdown, the banking sector will be at risk of further weakness, given that they are proxies to the economy. And at the same time, it is one of the few sectors that foreigners are quite heavy in. So if there is continued foreign selling, which we've seen already, the banking sector could continue to see further weakness. But of course, so far, the data, what we've seen from the banking sector has been quite robust. Earnings remain quite strong. Dividend yields are quite decent, quite attractive. But of course, in terms of upside catalysts, I don't think there is much I can see for the time being. So in terms of, to summarize, I think banking sector upside remains quite limited.
Okay, thank you, Mr. Lee. The next question is, shouldn't now it's still considered risky with the geopolitical tension with Taiwan?
Well, the geopolitical tension with Taiwan has been ongoing for many years now. One can only predict when things will escalate, but it's unlikely given that Taiwan is such a strategic country with, basically it dominates the semiconductor manufacturing industry. So even if there is an escalation in war and there's an interruption in the semicon manufacturing supply chain, I think the subsequent impact to the global economy can be quite severe. So I think US and China are quite cognizant of this impact. So hence, the base expectation is that there shouldn't be much of an escalation such that we'll see an all-out war between China, Taiwan, and the US. So for a moment, we don't see this as a possibility for the time being.
Okay, glad to hear that. And moving on to the next one, it's that in one of the slides, you mentioned that tug of war to keep volatility elevated. Can you elaborate more details and give example of some incidents?
Okay. Well, one example is, let's say, easily last month with the news of all the banking failures in the US and Europe, it caused the market to actually weaken quite substantially. But subsequently, there was a strong rebound with data that the Federal Reserve could actually slow down or pause their interest rate hikes, given that bank failures will likely cause Jerome Powell to actually think twice about hiking rates further, and that he might not want to tank the economy. So there is this tug of war where one day you have developments that are quite negative, like a corporate failure, but then market will suddenly realize maybe the central bank, because of this, will stop hiking rates. So market will actually re-rate upwards. So it's actually a very volatile environment at the moment. So we have been seeing and expect to see more conflicting news in the days ahead, which will cause volatility to be very drastic.
Okay, so we can expect more volatility in that, because the next question also touches on that, which is that what is the fund manager's current strategy in order to overcome the upcoming recession or related market sentiments?
Well, as mentioned earlier, I mean, go defensive, have decent cash, and ready to deploy when market does recover. We expect no change. We expect the central banks and the government to actually stimulate the economy should things start to should a recession start to happen. I think what we've seen so far for the past few years, the government and the central bank are quite fearful of a deep and prolonged recession.
Okay, Mr. Lee. And the following question, it's on what are your thoughts about glove stocks?
Yes, I think past few months we've seen a sharp rebound in the glove sector. Understandably, because it seems like what we've seen is that what we've heard from the corporates is that the worst is slightly over. So for the past year and a half, glove share price has actually continued to come down. But if you notice, the prices for the past 6 months prior to the rebound, glove prices has actually remained quite flat, even though quarter results continue to show quite magnifying losses. So it does indicate that a floor in terms of share price has been reached, and the sharp rebound coincides with the glove companies indicating that average selling prices of gloves has actually stopped declining, and they're actually starting to increase average selling prices. So it does lend some optimism to the sector that the glove companies could be on the way to a recovery. But of course, I won't be too optimistic on that, given that market dynamics are still very challenging. The biggest risk, of course, is your Chinese glove makers, where they are also, they've actually come out to be one of the largest glove producers in the world from previously minimal market share to now being one of the largest in the world. So they've ramped up production quite significantly. So any actions from the Chinese glove manufacturers, such as ramping up supply or cutting average selling prices, could actually unwind the share prices of the glove performance, what we've seen this year. But so far there's hope. I think prices now is starting to reflect that there is hope that competition in the sector is starting to become more stable, more balanced, such that we've seen a lot of consolidation in supply, and that demand and supply could actually be quite matched moving in the years in the months ahead. But of course, a recovery is unlikely to be seen this year. So don't expect any profits for the remainder of this year. If things continue as is, profitability could likely only happen maybe next year or even 2025. Who knows? So now what we're seeing is the pricing in of expectations and hope.
Okay, thank you. And there's a question on what are your thoughts on investing in gold as a way to stay defensive, and overall opinion on that?
Gold, you mean?
Gold, yes, investing in gold.
Gold as a defensive asset, it depends on the market conditions. So gold has done quite well, given that inflation remains quite elevated. But I think in the longer term, do realize that gold does not provide income. It's basically a commodity that does not provide income. So when inflation does decline and interest rate remain high, I think there are other assets which could benefit besides gold. So I'm not a specialist in gold, but it feels like it's only a temporary beneficiary of the current environment as inflation remains quite elevated.
Thank you, Mr. Lee. And we have one final question, I think. What is your, in view of the ESG defensive Sharia nature of this growth fund, does that mean that the fund is less exposed to global recession that we foresee in 2023?
Less exposed, I would think so. But it depends on what you're comparing it to, you see. So the target of the fund, of course, is to outperform the benchmark. So if you mean by that, then yes, I mean, the objective is if the Sharia index declines by 10, hopefully the fund declines less or even is in a positive position. So that's the objective.
Okay, so that wraps. I hope that we have answered all the questions. And if you still have any more questions, you can feel free to type in the Q&A sessions to our speaker for tonight. And let's just, okay, we have ended, we have answered all the questions. Thank you, Mr. Lee, for the very detailed and insightful explanation and answering all the questions. And once again, also, thank you for the presentation tonight. And I hope that we have learned a lot from your sharing. To all the attendees, if you have further questions, feel free to drop us an email at investhelp.my@fundsupermart.com. Also, currently, we are having a limited time promotion for 2 of AIIMAN's Sharia funds. So to get more details on this, do check out our website, FSM1 website, to get more details. And lastly, be sure to head over to our YouTube channel, which is FSM1 Malaysia, to watch the replay of today's session in case you want to, if you have missed out any of the pointers, and also during the questions, to watch the replay, you can actually head to our YouTube channel. Again, ladies and gentlemen, we hope that today's session added valuable tools to your investment decisions and your investment journey. Thank you and have a great evening, and hope to see you in the next session. See you, right? Bye-bye.
Good night.
Good night.